What's going on, everybody? Welcome back to another episode of Freedom Investor Radio. I'm your host, John Pearl, and today I am joined by Ken Gee, who is the founder and president of KRI Partners. Ken, welcome to the show today.
Thanks so much for having me, John. Looking forward to it.
Cool. Yeah, so why don't you tell us a little bit about what it is that you do these days and give us a high-level background about how you got there.
Yeah, so we are a real estate private equity investment firm. So we do multifamily and we syndicate. We have blind pool funds. That's what we do now. But let's rewind a little bit. I grew up in Toledo, Ohio. Got my undergrad there from University of Toledo. Then moved to Cleveland. Started working for a bank. I spent 5 years as a commercial lender. And while I was going to school at night at Case Western Reserve, got my master's in accountancy. Went to work for Deloitte then for 7 years as on the tax side. So got to do, some boring tax stuff, but I also got to do some really cool M&A work, merger and acquisition work, due diligence, a lot of transaction planning. It was really fun. But it was there that my life changed because my kids were young. This is 25 years ago, right? This is a long time ago. My kids were young. My daughter was newborn. And I tell the story a lot, but it's really the way it happened for me. I was doing her night feeding in the middle of the night at about 3 o'clock in the morning. And why was I doing it? Because I was working at Deloitte. It was the only good quality time I got to have with her. And it was cool. I liked it. It was great father-daughter time. Problem is, and it was awesome until one night I started realizing, wait a minute, this is my quality time with my daughter at 3 o'clock in the morning and everybody else is asleep. That's not how I want my life to be. And I started getting really frustrated, right? I was just working too much and I couldn't figure out, man, how am I going to structure my life so I don't work so much? How in the heck am I going to put my kids through school and not take on a ton of debt, all that kind of stuff, right? So I woke up the next day and said, you know what, I got to change this. And that's when I went on this journey to figure out real estate. It took me about 1.5 years, a whole bunch of money, because back then there weren't cool podcasts like this to help you learn about this stuff, right? It was really a challenge. And I ended up buying 3 small properties, all less than 30 units each in Cleveland, sold them about 3 years later, and I made $500,000. I was like, holy Jesus, are you kidding me? I just made $500,000 on the side, probably more money than I made when I was at Deloitte, where I was working 80 hours a week. I'm like, man, this is awesome. The reason it's awesome is because, remember, I told you I couldn't figure out how I was going to change my life. Well, guess what? I thought I had a plan. I just had proven that it worked. And now I was off to the races. I thought, you know what, this is cool. So that's how I got into real estate. And it's how I eventually left Deloitte. I'm thrilled to tell you that 25 years later, I did put my kids through school. They're grown, doing great, with no debt at all. That was awesome. I never missed their football games, their basketball games, their soccer games, their baseball games. I never missed any of that stuff because I was able to take control of my life. So anyway, I know it's a long-winded story, but it's how it was really a big deal for me back then. And it is now. Now we have probably helped hundreds and hundreds of investors do the exact same thing that I've been able to do in this business. So that's the story.
That's great. And I can really relate. You mentioned it was your daughter. You're spending time with your daughter, and that's when the light bulb came on. And it's almost exactly the same story I've got. My daughter
Really?
was born. Yeah, I've got 3 young children now, 6-year-old daughter, 4-year-old boy, and a 1-year-old boy. And when my daughter was born, I had that realization that I'm just trading my time for money, and I'm not going to really generate significant wealth working for somebody else. Now, I still am working for somebody else, but that's the purpose of what I'm doing now, is to ultimately free myself from that and create something of my own through real estate investing. So that's great. I love it. Now let's talk about, so you also have worked in a lot of real estate related fields. Was that as a W-2 worker, or did you create business around that? You said you were in the lending space for a little while. Talk about that a little bit.
Yeah. So when I first moved to Cleveland, I was a commercial lender for about 5 years. And in the beginning parts of that career, I got to rotate through various parts of the bank. I got to see the retail side. I got to see the small business side. I got to see the credit side. I actually didn't do much in real estate, but it's all credit, right? It's all ability to pay loans and analyzing businesses and things like that.
Got it.
So
was this before or after you started investing in real estate?
Before.
Okay, got it.
Yeah. So part of the story that I didn't tell you is the whole time I was at the bank, all my clients kept saying, let me ask my CPA, let me ask my CPA. I'm like, man, I want to be the CPA. I want to be the one the guy asks, right? So I'm like, all right, let's go be a CPA. And then when I got to be a CPA, I'm like, wait a minute. All these clients, and by the way, at the bank, I had so many customers that were in real estate and making a lot of money doing it. And then I went to Deloitte, and the Cleveland office at Deloitte had a huge tax practice in the real estate world. I'm like, man, come on, Ken. Everybody's doing this. Why are you not doing this? Why are you the one working so hard? So I nibbled around the edges on real estate. But if you think about it, lending, very important thing to understand in the real estate world. Merger and acquisition work, really important stuff to understand. Due diligence, really important stuff to understand. So everything I have done has kind of helped me become better at what we do now.
Got it. And so are you specifically focused on multifamily, or do you branch out to
Yeah.
other asset classes as well? Got it. All right.
No,
So let's talk
specifically
about what are
multifamily.
some interesting lessons you learned along the way as
And the
far
reason I like
as
multifamily
purchasing
is
multifamily. And I know
I,
you're raising capital, you're syndicating deals. Was that always the case? Were you always raising capital, or you said you did a first few deals on your own, right?
yeah. So the first 10 years, everything we did was just me and one other partner, maybe, or myself, for a couple of reasons. One, I didn't think about raising money then. And two, I don't know, I was kind of comfortable raising money from people to do something that I didn't really understand yet. I just struggled with that, right? I'm like, I don't want to learn other people's money. So after 10 years, I said, you know what? I think I get it, right? I think I understand it. And that's when we started going outside and raising more money. And we've probably raised 35, 40 million bucks so far.
Excellent. So what are some things when it does come to raising money, or if you're a passive investor, what are a few things that you should know before you decide to give your money to this sponsor, general partner?
Yeah, that's a really good one. Over the years, I've developed 4 rules that I try to talk to passive investors about, right? Because they all want to make money in real estate, but now they got to figure out, okay, first of all, they figured out how it fit in their life, and they realize they don't want to be the operator. They want to be the passive investor. Okay, if you're going to do that, how are you going to figure out who are you going to give your money to? How do you figure the situation out? My 4 rules, basically, rule number 1, you got to make sure you invest with somebody with some experience. You just do. There's a lot to learn in this business, and we don't know what's coming around the bend next. We just don't. And you want to invest with a senior management team that has been around the block a couple times, right? And is pretty well positioned to solve whatever problem's coming next. Second thing you want is, and this kind of comes along with that, is a track record. We've got a 25-year track record. We hired Verivest to go out and vet our entire track record so that when I send it to you and show you what our track record is, it's not just me saying, trust me, we did well. No, somebody else has actually looked under the hood. I think that's important. The next thing I want people to do is think about transparency. Make sure that whoever you invest with, and the best way to figure this out is to talk to people that have invested with that firm before, but you want to be able to talk to somebody at the firm that actually can give you the real answer about what's happening. We do quarterly reports that includes a P&L, a balance sheet, a rent roll, all that kind of stuff on a regular basis. And we give them a narrative. This is what's actually happening on the ground. And then we do our monthly Real Deal webinars too to help to continue to provide information. But that transparency is important. And the last thing, and this one's harder to figure out, and that is you want your sponsors to put their investors first, right? And so the only way it's harder to figure it out because you got to look at the terms of the deal and you got to see who's making money when. And what you don't want to do, basically, you can ask yourself this one question, and that is it possible for that sponsor to do really well and you not? If the answer to that question is yeah, it's possible, then you need to really think about that, right? Because you're giving them your money and you don't have any control over it anymore. And you want them to only do when you do. I just think that's the only fair way to approach that. So if you follow those 4 rules, that's what I want people to focus on, because I can't make it perfect. I can't guarantee you're going to find a perfect sponsor because things happen, but it really does put you in a better position. If you ignore one of those rules, then you're just like, wow, yeah, I can see why that thing went south on me. I invested with somebody that's never done it before. That's not a good idea. Does that make sense?
Yeah, absolutely. Love those. So to review, you want to make sure they have experience, the track record, transparent communication, and that they're putting their investors first. So yeah, these are all really good items to keep in mind, especially right now. It's crazy out there right now with what's going on in the debt markets. We've got people that maybe didn't buy right. They've got bridge debt, adjustable rate. There's some interesting things happening right now. I would say that over the past decade or so, you didn't really have to be a quality operator and you were still getting good returns. So there's a lot of those people
Yeah.
out there. And something, I think it was Warren Buffett who said, when the tide goes out, you see who's swimming with their pants down. I think we're seeing a lot of that right now, right? And so
Yes, you do. Yep.
another thing you mentioned was the passive investors. Real estate investing, many people get it mixed up that if you're a real estate investor, it's passive income. But this is far from the truth for most aspects, most examples of real estate investing. So talk to some of the main differences for somebody who may not be as familiar with the syndication. You've got your operators, you've got your passive investors. What's your experience been like in that department?
Yeah. So I think you're asking basically how a syndication works. And that is, so syndicators, I want you to think about this. The sponsor goes out and finds the deal. He locks it down with some of his own money, puts it under contract. Then he goes out and raises the money. So hopefully he puts some of his own money in the deal. Then he goes out and raises money from other people. Together and he has a very short time frame to do it. It's really difficult. It's a big challenge to do that. They put all those funds together and then they close and they buy the deal. Now that the people that are just literally just writing checks to going into the deal, those guys are probably passive, right? It depends on what else they have going on. There's a whole bunch of IRS tests. We won't get into that, but they are likely passive with respect to that deal. Hopefully they're not calling the property manager and telling them to raise rents, to lower rents, to do this, to do that. You know what I mean? That's stuff that the sponsor should be doing. Now, we've done syndications. We've also done, and this is interesting, we do a blind pool fund as well. And that is a little bit different, but we did it because out of necessity. We buy in really high demand markets. And so, like Florida, for example, when we go after a deal, there's probably 10, 15 other guys going after the same deal. So a number of years ago, I said, man, I don't want to just be another syndicator standing next to all the others, because how do I differentiate ourselves? And I said, what if we raise the money first? I learned this lesson from the private equity world when I was at Deloitte. Go raise the money first. Then when you go and approach a seller or a broker, hey, Mr. Broker, I got all the money raised. You don't have to worry about me not being able to raise money. I've already done it. And so it gave us a massive advantage. We're working on fund number 2 now. Our first fund is going very, very well. But there's I wanted to explain the difference, because the blind pool fund, right? The investors invest in the fund and the fund goes out and buys 1, 2, 3, 4 assets, whatever the case is. But now it's huge because we get such buying advantages when we've already raised the money, when I compare that to somebody who has to go out and raise the money.
Yeah. Can you talk about some of the main differences from your end when you're raising on a deal by deal basis versus raising for a blind pool fund?
Yeah, and I would say the biggest difference is usually track record. People that start off in this business of raising money, they typically start off on the syndication side. And the reason is the people investing in that deal, many of them, they want to look at the actual numbers of the deal. They want to also agree that it's a good deal, right? Because although the syndicator may not have a ton of experience, some investors just want to know. They just want to know exactly what the plan is, exactly where their property is, and really get to only invest in deals that they like. That's the syndication. Now, it's a completely different investor that invests in a blind pool fund, right? So when we talk to investors, they're getting an understanding of what KRI does, what Ken believes, what kind of deals we do. And that's where the long 25-year track record comes in. They can see all the deals that we've done. There have almost always been value add deals. We didn't spend 25 years doing one type of deal and all of a sudden, hey, give us your money and we'll go do this office building. That's not what we do. We've been doing the same thing for 25 years over and over and over and over and over again. So what happens is, because of that level of experience, people will say, all right, look, we get it. We understand what we want you to have that advantage. We'll make a commitment to your fund. And the investors don't really have the ability to say no, right? They make a commitment and they trust that I'm going to make good decisions. And we take that trust very seriously, as you can well imagine. But that is the biggest difference. It's usually a control thing for that investor. And that usually is because of the level of experience. Most people that are passively investing, they don't want to vet the deal. They really don't. That's why they're passively investing. So, but it is hard to raise money in a blind pool basis if you have no experience. Because now people they don't understand what you're capable of, what your credentials are, because you've got no track record to show them. Does that make sense?
Absolutely. Yeah, and when it comes staying on the topic of raising capital, what are some things that have worked well for you? Doing this as long as you've done it, I'd imagine you've tried all sorts of things, and some things probably work better than others. Can you talk about some of the things that have worked well and some of the things that maybe didn't work so well that you tried it out and never did that again?
Yeah. So you know what? It all comes down to people's ability to generate trust, to get to know you and trust you. And that you don't do that it's not like you're walking down the aisle at Walmart and you grab something off the shelf and buy it and take it home. That's a pretty quick decision to do that. In our world, it's not like that. Most of the time, people experience us in some way, shape, or form 6, 7, 8, 9, 10 times. We've had people that stalk you, right? They follow you around for a couple of years, even because they want to see what kind of person you are, right? That's really important in this business because our minimum investment's 100 grand. Well, you want to make sure that you know who Ken is and who KRI is and what we do and how we do it and why. What matters is it's about that relationship. That's the key here. And so now the question is, how do you reach people that want to invest? We've done money shows, we've done webinars, we've done in-person meetups, we've done all kinds of things. And it always comes back to, this relationship, right? You and I are having a conversation right now. And over time, you start to say, okay, I understand how Ken thinks. I understand what he does. And they get to see you in a lot of different scenarios and they keep seeing and hearing, hopefully, the same message. And that's what I think is the most important. It is a long game. It is not something where you can just wake up one day, go raise $5 million, and then it doesn't happen that way. It takes a very long time to build up that level of credibility and trust.
Absolutely. Do you have a typical investor, like a stereotypical type of person, type of job that invests with you? And on that side note, do you have any experience investing or bringing on institutional money in family offices, things like that?
Yeah, so good question. We have, for the most part, stayed away from institutions. Institutions write big check, but they also want a lot of control. And we would prefer to maintain control of our own investments. That's my preference. We have worked with some wealth management firms in a big way. They know real estate's a good investment, right? And it's solid. And so they put a lot of their clients in it. We do that a lot. The typical investor, we only allow in accredited investors right now. So you have to meet the minimum income and the net worth requirements. But the important thing is when you think about what kind of person invests in real estate, it is literally all over the map. In our funds, we have DOJ attorneys, we have NFL referees, we have film producers, we have business owners, financial planners. I'm just trying to think off the top. Business owners, couple small family offices. It literally runs the gamut. And it's actually really cool because you get to really meet some interesting people. There is no doubt about that.
Yeah, so NFL referees are accredited, huh?
Yeah.
Nice.
We have one investor who is a retired Super Bowl NFL referee and just the coolest guy you ever talked to. Just the coolest guy ever. I love talking to that guy.
Oh, that's great. Yeah, it makes sense. I never really thought about it like that. You mentioned you're in Florida and you're located you invest in Florida, you're located in Ohio, right?
Yeah, so our company grew up in Cleveland. First 10 years that we spent there. I still live in Cleveland. My wife has a wonderful job working for an infertility clinic, and she absolutely loves it. And they do some incredible things to help people. So she loves that. We don't do anything in Cleveland anymore. It's just not a growth market. We would rather be in a growth market like Florida. It's just a 2-hour plane ride. Our corporate office down there is like 10 minutes from the airport. So in a couple hours, I'm at my office in Tampa. I like growth markets. It's night and day what you can do in a growth market versus a non-growth market like maybe Cleveland. We made money in Cleveland, but it's hard. It's a lot harder.
Yeah. So let's talk about your business, KRI Partners. So you guys, you've obviously invested, have a ton of experience in real estate, but on the business side, can you talk a little bit about how the business is set up, like employees, departments, how big you guys are? And I'm very interested in, I think a lot of the listeners are interested in that point where you take it from you're just an investor to a point where you make it a business and you scale up.
Yeah. So first of all, it has to be very purposeful, right? Scaling a business is when you're scaling your business, you actually have to think very differently because what happens early on is you do everything yourself early on, right? You know how you do this and how do you do that. And you know how, well, over time, what you have to do is document those processes so that you can transfer that knowledge to somebody else. And until you do that, it's very hard to grow. So we've gone through that process. We now do our own management. So we're vertically integrated. So we manage our own stuff. We also do some third-party management. Probably combined, we probably manage right now at the time like 18 or 1900 units. Our senior management team has managed about 15, 16,000 units over the years. So they're pretty deep experience. We probably have 50-ish employees. We probably have deployed at the moment probably 85 to 90 million dollars in assets. We've raised over the years about 35 or 40. I'm estimating, I can't remember exactly what the numbers are. Well over a couple hundred investors. It's like anything, you should grow a business in a responsible way and make sure that what's important is that you have that foundation underneath it, especially when you're going out and raising money from others. Like, I think if it's one thing to lose your own money, it is a totally different thing to lose somebody else's money, right? So you need to make sure that foundation is there and everything is in place so that it functions. Because if you think about it, if we manage 1,800 units, we probably turn 800 units a year, 900 maybe. That means that 900 move-ins have to go, and they have to go well, and I'm not there. So think about the processes and systems you have to have in place to make sure all that happens. And we've done that. Now, if you don't want to do your own management, do third-party management. I prefer to manage my own stuff because I've spent 25 years learning the business. It seems like it would be hard for me to go find a third-party manager that has been as dedicated as we have been to making operations as efficient as we can.
Got it. So at what point, many people, it seems, without knowing more than we've just been talking, we just met, but it seems like at the point before you started KRI Partners, you're doing pretty well. And what was it that made you want to, like, when you form a business like this, like a lot of the desirability of real estate investing is you generate cash flow and you can go and you can still receive the cash flow from anywhere in the world. But when you form a business out of it, it's almost like another job, right? So what was it that made you want to create KRI Partners instead of just sticking with the individual investor route?
Yeah, I wanted to build something that would be mine, right? It's fun to build a business. Some people might disagree. That's fair. Certainly, there's plenty of people who probably disagree with that. But when I was working at Deloitte, when I was working at the bank, I was building something for someone else. I was making someone else wealthy, basically. And I just said, you know what? I wanted to be in control of my life. When I said I didn't miss my daughter's basketball games, my son's baseball games, I'm serious. That was really, really important to me. Well, if I was working at Deloitte, you don't call, you don't ask in the middle of busy season, hey, do you mind if I take a couple extra days off because I got to go take my daughter to Kentucky to a basketball tournament? They would be like, what? Are you kidding me? That we're in busy season. No, you can't do that. I wanted that control. And that was really important to me. So it's the best of both worlds. One, you get to be in control of your time. And two, as long as you treat it like a business and it's not just a job, we've got 50 people. We have some incredible people that do some incredible things. We're recording this podcast and my phone's not ringing off the hook because we have really good, solid people doing the hard work that it takes to make this business successful. So that's the important thing, right? I'm so thrilled, and we're going to continue to grow. We're going to double, triple, quadruple this thing and continue to do that responsibly, though, because I want to create really good opportunities for people, but I also want to help investors. If you do the math on what you can be as a passive investor in this business over a period of 5, 10, 15, 20 years, it's ridiculous how much money you can make in this business.
100%.
And so now that I'm older, I really appreciate having the ability to help other people, not just get into this business, not just as an employee, helping them reach their goals, but helping investors get that mailbox money so they don't have to work anymore.
Totally. I love everything you just said. And as I mentioned, I'm still full-time W-2 worker and building my real estate business on the side. And
what I did early on. Yep.
Yeah, it's good. It's become a hobby. I don't want to go out and party. I don't want to watch TV. I want to build this. It's enjoyable building something for my own. And I've studied enough and talked to enough people like you to where I realize it takes time. You have to get the reps in. You have to try things, make mistakes. You have to fail, learn your lessons, try something new. And so it's, when you look at it like that, I've found at least that it's very enjoyable creating something on your own. So I couldn't agree more with everything you just said.
Yeah, it absolutely is.
Great. So I want to pivot over again, get back more on the kind of what's happening right now in the market. So very interesting things happening right now. I'm talking to a lot of people who kind of behind the scenes talking to people. They're not really promoting these deals like they do, like they were promoting the ones that had a 3x equity multiple over the past decade. But there's some people having some issues right now with
Yeah.
their bridge loans that they've got. They're coming due. Their rates have been skyrocketing. It's been adjustable rate. Do you have any experience? Have you had any deals like that? Or do you know anybody that's had deals like that? And what are they doing about it?
Yeah, no, I know a lot of people that have deals like that. We're pretty well protected. I went through the 08, 09 financial crisis. So managing debt and working for a bank, managing debt actually has always been more important to me than probably to most, because you're right. When things are going so well, you just don't think about these things. Rates, what the Fed has done with interest rates is there's not a human being on the planet that could plan for that. I mean, you can't hedge that kind of risk. So yeah, you're right. What's happening? Here's what we do with our business. Our business plan is incredibly deliberate. We only buy good properties in growing neighborhoods that we know, because we've done the homework, that we can increase cash flow, not just a little bit, but significantly, a lot. And the reason that's so important, the good neighborhood thing, really important, right? Recession, who gets hurt? The bottom tier properties. It sucks, but they're the ones that get hurt the worst because they get laid off. When you overbuild, who gets hurt? The top of the property stack. So we stay in the middle, right? And we like to do that. That's where we like to be. We like to be in growth neighborhood or growing areas. Why? Because we want demand to outstrip supply. That's how operating with a tailwind and not a headwind, right? If it's the other way around, it's a huge headwind, and it's really hard to raise rents when you got more inventory than you have people that want to live there. So, and then the last piece of this is the huge piece of this. It's staying disciplined and making sure that your deal has the upside. That means getting in your car, driving around, pretending like you're a prospective renter, and understanding where your property fits into the comparable market. And then when you're done fixing it up, what is it going to look like then? And really understanding that market, right? It seems obvious, but so many people struggle with this. The reason we want so much upside is when you think about new cash flow. We have an 84 unit property in Tallahassee. We've moved our rent roll $30,000 a month. Well, when you have $360,000 with a new income that literally fell to the bottom line, do you think that gives you a lot more options when interest rates rise? Absolutely, right? Yes, you were able to sell it and make more money, but it also gives you a very defensible position. Rates go up, you're cool. You can still pay the interest. Your rate cap expires. That's cool. You still can handle that rates. You want to refinance, you have enough new cash flow, even with higher cap rates, to do that. So the business plan is what's critical to protecting yourself here. And then just don't, I call it naked borrowing. You don't want to borrow naked, right? You don't want to be on a variable rate loan and not have any kind of protection. So when I see people getting in trouble, it's because they were naked when they borrowed and the rates just cranked up on them, or they have rate caps and they are expiring and they weren't able to get enough new income to support a new loan. You see, so it all comes back to the business plan. That's why the business plan and the discipline in my mind and the underwriting is so critical to this thing, because it's the best way to protect yourself. And so, yes, some people are in trouble. They got to sell. Some people are going to give their buildings back to the bank. They've got some issues, right? We don't have any of those issues, thankfully. In fact, we're probably going to refinance one that we have a rate cap expiring in a couple of years, but we have the ability to actually refinance, get some money out, I think, and possibly lower our interest expense. Why? Because we have all this new revenue that we didn't have when we bought the property. See how it protects you? That's why the upside is so critical.
Do you have a typical area loan to value wise where you try to hit, and has that changed at all over the past few months?
Yeah, so it depends. It used to be your deals were always debt coverage limited. And by that means, whatever the debt service was, you have to be able to cover it with your cash flow of the property. Now it's getting more to a loan to value thing. Typically, we're at 65% loan to value, plus or minus. We're definitely over 125, 130, 140 debt coverage. It just depends on the deal. But you want to stick in that range, because I know I've watched a lot of people over leverage themselves. And that's what you want when you're going to have downturns in any industry, in any business. And you just don't want to be so leveraged that if you have income drops off a little bit, suddenly now you can't even break even. You don't want to lose your real estate, because usually what happens is if it's going to come down, it'll probably come back. The problem is when it's down, you don't feel like, oh my God, this is never going to turn around on me. And it always does. You just have to be able to wait it out. Well, if you don't have enough money to make your mortgage payment, it's going to be very hard to wait that out, right?
Totally. What do you see as far as one man's problem can be another man's opportunity? All these deals that are struggling right now, do you think there's going to be a big buying opportunity over the next 12 to 18 months or sooner, perhaps? What are your thoughts?
Yeah, no, I do think there are great opportunities. They're coming. I don't know that there's going to be blood everywhere, right? But a lot of people will say there's going to be blood in the streets. I don't know that it's going to get that bad, because what will happen is as people get closer and closer to that D-Day, I don't know what else you want to call it, but that's what it is for them. They're going to get more flexible with their selling price. They just will, right? So 6 months ago, the price gap was ridiculous, and because they were trying to sell at year ago prices, but you can't do that. If you want to sell right now, you're going to have to get more realistic, because a buyer is not going to come in and have negative leverage. Because why would you do that? You should never have negative leverage anyway. But the lenders won't even let you do that now, right? You're going to have to put more down, and you're not going to have any money for your investors. So you need at least even leverage, and you got to have a little money left over for your investors, right? And so it's just a matter of when sellers, when they get enough pain that they're like, okay, I need to meet the market because that's the right thing to do. And that's what's going to happen. So people like us will be there to buy. I'm not looking to screw anybody and to just really rake them over the coals. I don't think you need to do that. I would rather treat somebody fairly and sell them at a price, buy it at a price that I can make work, right? I'm not going to put 60% down. That's silly. I'm not going to do that. But at 65% leverage, you get 65%, you get even leverage and some upside. We'll buy it all day long, because that's what we've always done. It's the same business plan we have implemented for a very, very long time, and it works in almost any market.
Right. So we've had unprecedented, since the 80s, the hiking of the interest rates over the past, I don't know, a year or so. But we've also had unprecedented QE, quantitative easing, money printing. So it kind of feels like, even though the markets are coming to a halt and there's a lot of problems, like as soon as there's a relatively significant dip, or I guess it won't even get to that point, what I'm trying to get at, there's still so much money on the sidelines. What are your thoughts on like how far down is this market going to go?
You mean the real estate market?
Yeah.
So I think it's going to depend on what market you're in. I don't see anything destroying. People want to move to Florida. They want to move to the Sunbelt states for lots of different reasons. And most of those reasons, I can't figure out how to make them turn around. And as long as that happens, that's going to provide a great deal of relief on how far down that market goes. Now, if it's a market that's not super popular and a little bit of change in demand changes everything for them, well, they're going to be far more easily impacted and far greater. The impact's going to be far greater than it would be in a market like Florida. So I don't know when the bottom is or when the top is. I don't know that. I don't try to call that. I just try to stay disciplined on a business plan that we know works. That's what matters. See, I think, though, if you buy now, I don't know how you can get a better time to buy than right now. Because if you're buying at cap rates that are reasonable and there's upside, and oh my gosh, what if you got a little interest rate relief? What if you got a little relief on the insurance side? That's just icing on the cake, right? If you stay disciplined and buy properties with upside, it just makes sense. So we're anxious buyers. There's just a lot of people that are anxious buyers, but we're always in that environment in Florida. Everybody wants to buy in Florida.
Yes. So Ken, with your background in banking, and so I recently, before the show, I hopped on your YouTube channel and I watched a nice video that you did, a nice short video about the bank failures and their effects on real estate. If you could just give a high level background overview, take a few minutes. And I'm very curious. We've had the 3 bank failures recently. There's stuff happening internationally. And how is this going to, in your opinion, impact the real estate market?
Yeah. So first of all, the failure of banks creates a lot of volatility. I think the government did a lot of things right. The Fed said that the banks can go to the discount window and borrow against those securities, even though they went down in value. They'll pretend like they didn't. That's a big deal. It gives banks liquidity, right? Because SVB would not have had to sell those securities had that been in place before. That $2 billion loss that triggered the run on that bank would have never happened. They sold it. They took that loss because they needed the liquidity. Well, if instead they could have borrowed from the Fed, it wouldn't have caused a problem. See, that's interesting, right? That change that the Fed made was in response to that because they figured out what happened. Because every single bank in the country is holding securities that they're upside down in right now. They just are because rates moved, and it's just the way it is. And then the other thing, they stepped in and they said, this is the biggest deal. When the FDIC said, hey, I know insurance is only to $250, but don't worry, depositors, we got you. Basically is what they said. A nod and a wink, you're not going to take a loss. Well, that prevents bank runs, right? So now, what did those three bank failures do? They helped. So when you think about why is the Fed raising rates? They're raising rates to fight inflation, right? They're trying to destroy wealth. They're literally destroying wealth and destroying demand. And that's how they get inflation down. They can't affect the supply side of the equation, so they got to affect the demand side. And it really sucks thinking about that. If you think about this for a minute, your government is purposely trying to make you poor. Now, that's an exaggeration, right? But I'm trying to illustrate a point, and that is by raising interest rates, that destroys wealth. That makes assets worth less. That makes a lot of things worth less. So people have less buying power. When they have less buying power, eventually they'll stop buying. So that's how they impact the demand side of the equation. Well, the other thing that can impact demand is when banks tighten credit and they don't lend as much. So that slows down the demand too. So now they're getting some help from the banking world, who I don't know when this will air, but they've tightened their credit standards, right? They say, hey, we're not going to be as easy peasy to borrow from anymore. We're going to hold higher standards. That means people are borrowing less. They're borrowing, you have to have higher quality people borrow. So that just results in less spending. So the Fed's actually getting some help from this banking thing. I know that's a weird way to look at it, but that's how you have to look at it. It is helping them. So what I care about is that we get inflation under control and the Fed doesn't continue to just keep raising rates. Eventually, if they just keep raising rates, there's not a deal alive anywhere that will survive that, because it just won't, right? It just won't, unless you happen to have 20-year debt on your property and you're lucked out. Nobody has 20-year debt on their property. Very few. There's HUD loans available, but most people don't take advantage of them. So that's the biggest impact that the banking crisis has had. I think it's over now. I think looking forward, I just talked about this the other night, we have to see what's going to happen with a lot of these smaller banks that have all these office loans. I think the office space, that whole world's going to have a little bit of an adjustment. So there's going to be some stress on that side of the banking world. Those are real losses to banks. And then if some of the multifamily deals go bad because they're not able to refinance, they didn't have enough cash flow to pay the higher interest expense, you might have some more stress in that banking system. But all that's going to do is tighten up credit, and it's going to make people more disciplined, and it's going to reduce demand further, which will hopefully stop the Fed from raising rates, right? Because as soon as the Fed stops raising rates, the degradation, that deterioration of people's wealth slows down. Does that make sense?
Absolutely. Yeah.
So I know that wasn't very high level, but it is what it is. And what I care most about, it's very hard to transact in a very volatile interest rate environment. So what I care about is stability. If I have a stable environment, I can at least then go under contract and work to get my loan done in the next 60 days. I can't do that if rates have gone. I mean, if you look from the day of right before the bank crisis to the day after, it was like 80 basis point swing. That's an incredible amount of money on a 10, 20, $30 million loan. Think about that.
Yeah, it really is. All right, Ken. So time for one last question. This is a question
Okay.
I ask all my guests. It's the whole purpose of the show. For a quick background, I work at Diablo Canyon Nuclear Power Plant. It's on the central coast of California. They've recently announced that they will be shutting down at some point over the next decade. That also plays into my story of building a real estate empire. But what would you offer? What one piece of advice would you offer to folks who are looking to escape the W-2 world and create something of their own, whether that's via real estate investing or entrepreneurship?
So what you have told me about your story is what I would tell people to do. You have your job and you're starting something else on the side, allowing it to ramp up. Maybe when this one ramps down, this one ramps up, and you're good, right? You're going to meet somewhere. You're going to decide, okay, now I can quit my job. That's the best advice I can give people. So many times I see people so eager to jump over that fence and get to the greener grass on the other side. They do it prematurely. And you got to be careful with that, because real estate, you don't get rich overnight in real estate. You just don't. So it takes time. I call it you can't really say this, but it's a get rich for sure thing. It's not a get rich quick. It's a get rich kind of for sure. And you really can't even say that, but it's much more realistic to think that over a 5, 10, 15, 20-year period, right? My kids, they're more than 20 years. Think about that. I started off in this business 20 years ago. 20 years later, man, I'm in a so much better place than I was 20 years ago, right? And that's the advice I give. Just figure out whatever it is you're going to do, start it on the side, and then grow it slowly. And at some point, you'll know when the jumping off point is. Just don't ignore that first thing. Don't quit your day. I always tell people, don't quit your day job just yet. Wait till you can support yourself, because you just want to do that.
Yeah, I think if I didn't have kids yet when I had this realization, I probably would have burned the bridges already or burned the boats. But
yeah, I know that position. I had too when I started. I know it well.
All right, Cam, great conversation. Where can people reach you if they want to learn more about your business or get in touch?
Yeah, so go to kripartners.com/invest. That'll give you access to all of our track record, all of our investment materials, our latest webinar in terms of what we do and how we do it, all kinds of information. That is a really good place to start. kripartners.com/invest. It's easy to remember. And hopefully we get a chance to talk to some of your listeners. I'd love that.
Excellent. All right, Cam, much appreciated. Enjoyed the conversation. Thanks so much for
Same
your time.
here. Thanks so much, John.